Bloomberg Audio Studios. Podcasts, radio, news.
Stage cough, like Shakespearean almost.
Just, a few vocal warm-ups. Welcome to the Merryn Talks Money weekly roundup, our debrief on the biggest stories in markets and economics. I'm John Stepek, senior reporter and author of the Money Distilled newsletter, and this week I'm standing in for Merryn while she's off in Dubai. And no, she's not on holiday. In fact, she's recording some very interesting conversations for the show, mostly with people who've fled Britain for tax reasons. I'm only joking, but maybe she is, which we'll bring you in the next few weeks. So with me instead of Merryn is our usual backup, Mr. Marcus Ashworth. Welcome back, Marcus. Good to have you on the show again.
Always a pleasure to be here.
Yes, so this week we had a trade war that lasted for a remarkably short period of time.
Yeah, it lasted all of 24 hours, which was a shame because as columnists, as you know, we always queue up. We've got about 15 stories. My God, what's going to happen to Malaysia with every thing on the planet? But I managed to get one in on Europe, and that was that. It's done. It's over.
I know. I was hoping to kind of have my money distilled for the week out of this, but yes, it was rather short lived. What is this? What does this remind you of?
It's rope-a-dope. It's like watching Muhammad Ali, and this is it will come and it'll go hot, it'll go cold, because this is exactly what he controls the world with. You could admire it if that's not the right. I'm not trying to encourage him, but the point is that he's able to turn it on, turn it off. He's got quick wins with Canada and Mexico. That's definitely not the end of it. There'll be more if and when they weaken or something changes and he wants something else. But this is, to my mind, all of this is masking the control game, which is really divide and rule, get as much of the West behind him. That means Europe, that means obviously Canada, Mexico, etc. And the end game is China. And so they're starting off with 10%, which is, and we saw the response from President Xi, which is 10% on US oil and gas and autos, which self-respecting Chinese person buys an American car. And indeed, yes, well, it's done deliberately. I think this is pre-planned, pre-organized with Xi. So I think there is a bigger end game here, which will take some months and possibly years to play out.
But what is the end game in that case?
This is the whole, US versus China, the two great hegemons, battling it out, and whether it comes down to, Taiwan or whatever it may be, this is the big existential battle, and I think this is what Trump wants to do, is to try and, he's got a number of different agendas all running at the same time. It's hard to keep up, but we saw him play a very interesting card with Gaza. I think clearly Ukraine is coming next. And then he'll turn around to Europe and on the defense side. And I think that's something which he wants to see some form of win, Ukraine, Russia-wise, in the sense of some end to the war, or certainly progress towards an end to the war. And then he'll focus in very much on Europe. Firstly on defense, as their weakest link. And then from that, he'll extract whatever else it may be. And it could be as simple as buying US bangy things or US LNG. This is the whole problem with the LNG. It makes a lot more sense to sell US gas into Europe, but long-term contracts of how the US have always played it, Europe doesn't want to play that game. What it really wants is get Nord Stream 1 and 2 back up again. Nord Stream 2 could be set up within months, and that's clearly where Germany's angling, and I think he sees that loud and clear, and I think if Europe are belligerent with him and literally try and go straight back to the old game of getting cheap Russian gas, you can see why they would want to do it, but I don't think he'll let that happen. So there's a battle to be fought with Europe, but as I said, that's just a means to an end, and the end game is very much, I think, to having some form of either deal with China or very clearly the world more united around Trump's view, against what they see as a much bigger problem, which is China's influence everywhere.
And in terms of, going back to what all this actually means for investors, about the only thing that seems obvious to me since the start of this year, and I would throw DeepSeek into this as well, is the fact that the US has kind of been priced for perfection for a long time, and it feels as if some of this volatility might, spark a bit of maybe a catch-up trade, maybe the rest of the world starts to do well finally, or is this just wishful thinking?
It's wishful thinking, and I think that's the basic point here is that the reason why the US continues to do so well is it has genuine profitability. And you can call some of that possibly greedflation in the sense of corporate margins being increased and using high inflation in various other different ways. But leaving that aside, the reason why the Magnificent Seven are magnificent is because the level of profitability from the monopolistic practices maybe, but they really have got strong profit growth and foreseeable, which is of a different order of magnitude in anything else in Europe, really, should we say. Japan is yet to really kick in its whole reform. That's a play which is slightly separate, but with regards to the best shirt by far, it's still the US, and that's why monies keep on flowing into passive funds. It's hard to break that cycle. It needs a very big catalyst. That may well come from trade wars if they were to get out of hand, because what you do with tariffs is it's short-term inflationary, but it can be very growth destructive, and then what happens, you get a sort of squeeze on people need more dollars because prices are going up essentially of tariffs, and then you get the causation of the cure for a higher dollar is a higher dollar, in the sense is that you then get into a demand shock. So a supply lack of dollars can turn into a demand shock, also to the downside if it carries on, squeezes too much, which we've already had very painful last few quarters. So I'm not saying there isn't a chance for recovery in Europe and the UK particularly, but it's going to be hard still to break the king dollar trade, and we're seeing that in price of commodities like gold, certainly. So I mean, a lot of this is following through. In the moment, Trump so far, you can see it the way bond yields have been doing very well, actually, after a very difficult time. Clearly, people are putting money to work in US Treasuries and to a certain extent gilts and various things like that, which is post-Trump, is that everyone's waited until the inauguration. He hasn't done anything too crazy, that tariff sort of wobble aside, and that means that people will probably put a trade on which is a safety trade, which is buy bonds more, and equities will be less attractive, but still most people have got their bets on and sticking with those bets, and that, until that changes, I think the stronger dollar, the pretty robust US stock market, without necessarily going to great new highs, will remain, and possibly some of the scares over bonds will ebb and flow and reduce a little bit as the Fed sees that US growth is tapering off a bit, as that's less stimulus coming through. Now Biden's no longer with us in that sense, and that means that probably bonds will have a more comfortable year, but still it's not a massive shift away from equities into bonds.
Just on that point, because I mean, one of the few bits of good news, maybe the only bit of good news that Rachel Reeves has had for a while, is that UK gilts are kind of coming back quite significantly. Yields are down sharply, and presumably that's just all part of this global move, isn't it?
It is. I think gilts have been a real proxy for the major trade, which is shorting US Treasuries, worrying about deficits and fears of Trump, etc. I think Trump's going to be quite careful on the deficit, and that's certainly, I think, the Biden era he was more successful than perhaps he should have been in getting stimulus through, and we're going to have a bit of a downdraft of as stimulus wears off, and I don't think tax cut bill aside, which he seems to be pushing towards the back of his agenda at the moment, but he will get round to it, I think, in the next quarter for Trump. But there may well be some good news on deficits. I think hedge funds have been particularly playing the short bond trade, and that's been clearly semi-unwound. I think long money, as I said, is starting to put money to work in US Treasuries after waiting for the inauguration. But that trade has been definitely, hedge funds have been, I think, borrowing too much from the Bank of England, the repo facilities, and they have been playing the short UK trade very, very aggressively. And I think, therefore, the short squeeze perhaps is going to clearly is playing out more in UK gilts doing better. And it's a possibility the trend may have broken between gilt yields and US yields. It's one to keep an eye on, is that clearly gilts, as I said, have been literally on the naughty step for too long. And if anything, and bonds continue to do better and yields fall, I think you should logically see as a higher beta trade that as shorts get taken off, that gilts do better.
Yeah. And I mean, obviously, in the longer run, that's also kind of good news for example, the UK housing market because the swaps rates go back down.
It's too marginal, and I think there's some wider issues with higher taxes and a few other things coming through, which I think will keep a lid on UK house prices. I don't think there's going to be much love from the Bank of England sufficiently quick enough. I think they will cut more over the course of this year, and I think gilt yields will steadily go down. But I think it's going to be a modest effect rather than necessarily anything supercharged. But I mean, there's definitely Reeves has a interesting February because they calculate it from now on after the Bank of England meeting this next 2 weeks is when they calculate the OBR, the sort of where gilt yields are, and then use that number in March 26, and that will determine how much he's breached her headroom, and what happens from that we will see March 26. So we've got some interesting times ahead, but Bank of England is getting out of her way, but it's just too, like all their growth plans, they're all too slow and not quick enough to necessarily make, unfortunately, the spending cuts and possibly other tax measures coming in March 26.
I'm curious here because obviously I've heard a lot of different views. Do you think that she will decide to do more tax hikes or spending cuts in March? Because obviously that's politically that's going to be really difficult.
Yeah, I mean, the thing is that Starmer and Reeves are literally making enemies of whole sets of people, and they're quite careful. They might be doing the same to their own backbenchers. But they're the easiest ones to with such a massive majority, they can, and so far very, very tightly controlled ranks of backbenchers, unlike the Tories in the previous governments. So in that sense, I think welfare spending cuts, particularly on disability, but is the most obvious in-year, deficit reducing measures you can do, which is cut government spending, and welfare spending is I'll not say the easiest politically, but it's the simplest and quickest ones you could probably do. Will there be further tax rises? Absolutely, but I think they will probably wait until October-November budget, which will be pretty unpleasant, I suspect, for the average person. You and me.
Yeah, that's what I'm thinking. Oh, great. Okay, I think just before we go, can't ignore one of the show's favourite topics, which is the gold price, which has hit, actually really quite aggressively hit a new high this week. I mean, I'm just looking at the Bloomberg terminal here, and it's up over $2,870, and it only just breached 2,800 for the first time a couple of days ago. You got any theories on this one?
Yeah, I've been speaking to the World Gold Council, and they produced a report earlier this week, and in essence, it's central bank buying again in December, and that the biggest central bank will be China. We don't know that for certain, but it's more than likely it's the biggest buyer, continues to be the biggest buyer, and that is the Chinese buy, either by retail or indeed official buying. So. Yeah, I mean, it's an ongoing trend, and it doesn't seem like it's stopping. You could argue world sort of disruption and trade fears and all the rest of the tariff stuff, which may prove ultimately to be less fearsome than some had worried about, but it's not going away. And, gold seems to have clearly a momentum, and I think 3,000 is evidently going to go at some point, and there's no reason why necessarily wouldn't carry on. So, the trend is your friend at the moment until something changes, the world all of a sudden becomes a calmer, quieter, more beautiful place. There's no evidence that's going to be then gold. I have no real understanding why it's carrying on going, why they continue to buy it at the highest levels ever. But, if anyone in the world worries about something, and it only requires one constituency to be requiring safety, security, and a sort of rainy day fund or outside of their own country, then that's why gold goes up, and evidently that's what's happening.
I mean, one of the theories I've read, I think Charlie Morris over at Atlas Pulse has written about this a bit, is the kind of theory, because the correlation between gold and bonds and interest rates is basically broken. And part of that might be that, people are starting to worry a bit about sovereign credit risk.
I don't really buy that story, but I mean, I think it's more that, for instance, China has worries about its dollar exposure and indeed its own currency, and maybe is transferring assets. there is some chat that the insurance companies in China can indeed start now allowed to put gold on their balance sheets, and that's a new constituency of buyers. Whether that's why they would want to do it at the all-time highs is beyond me. But there you go. Maybe there's a bit of asset allocation shifts going there. And indeed, it's just, retail demand behind it. As I said, if you're worried about loss of capital or return of capital, then you would buy. You don't care so much a return on it. You just want to make sure you've got something. And if the property game is not the way to go, then gold is the obvious alternative. So as I said, it's just quite one part of the world. Wealth is at risk, and it can get into gold, and it will do, and that's been the history of the world, isn't it? So, and Bitcoin, for whatever reason, isn't quite as extractive at the moment than it was, but that'll change next week probably. So, the honest answer, I don't know, and I don't think anyone else does, and I don't think any correlation with bonds or anything else, Bitcoin, you name it, with gold makes any sense at all.
So long story short, just stick with the momentum trade.
If you own gold, there's no reason to sell it. As I've managed to miss out on the last $1,000, I will continue not to buy it and sell it.
It's always a good strategy. Right, well, look, thanks very much, Marcus. Really appreciate your time as always. And I'm sure we'll get you on next time Merryn's jet setting around global tax havens.
My pleasure.
Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review and subscribe wherever you listen to podcasts. This episode was produced by Summer Sadie and Moses Andam, sound designed by Blake Maples, and special thanks to Marcus Ashworth. And as always, questions and comments on this show and all our shows are very welcome. The show email is merrynmoney@bloomberg.net. Thanks.